What's up guys, my name is Richard. If you're new to liquidity pools and you don't know what ranges to set, or maybe if you've been burned by setting ranges too tight in the past, then this video is for you. So we're going to go through how to set up ranges and the step-by-step I go through. And the goal hopefully is to help you make more money while preventing you from making mistakes like setting the ranges too tight and then incurring a lot of impermanent loss when the market is really volatile. And before we begin, here's a quick portfolio update. It's still negative $28,000 profit and loss in US dollar terms because the alt market hasn't recovered yet. And a lot of it is actually from this Pixel and ETH position that I rebalanced into when I was in profit. So it's still doing 47% APR even with lower volume, and I'm projected to make around 3,700. You can see here my earnings versus holding is beating impermanent loss with a comfortable margin. With the total earnings, the impermanent loss is only like $1,000 something, right? Almost $2,000. So doing great here. Still have almost $3,000 to claim near the end of the month. And if you look at ETH profit and loss, it's around 3.68. And a lot of times I'm not in profit all the time. Sometimes pools don't do that well, for example this ETH and Arrow pool. But the longer I stay in range and if the price recovers a bit, then I'm more likely to get into profit. So just a quick recap so that you know that this is what I do. I don't just talk about concepts without actually applying them. So the first thing we want to do is we want to start from the big picture. We want to look at the weekly chart or the monthly chart rather than the daily chart. The reason why I like doing that is because it forces me to longer term thinking, right? I'm looking at longer term price action. I'm not just looking at the daily, what's going to happen the next day. So in this scenario here, let me just explain why you want to think long term, right? So back in January or February of last year, a lot of people were actually yield farming with tight liquidity pools, right? So let's say you had the perfect entry to the market when the market was kind of grinding sideways a bit from 2800 to 4100. So some people think this range is quite wide already, but actually it's not. So if you see here, even with the perfect entry, I would be in range for roughly 168 days. So just right under 6 months before I get knocked out of range and I'm not earning any fees. And if I had to rebalance, I had to widen my range or I would be forced to realize some impermanent loss to rebalance and capture the new range. And down here, if you have a tight range again, right, it's even worse because you're in range for maybe like 98 days before it pumps out of range, right? So a lot of people were doing that to yield farm ETH and USDC, right? And then this is even worse, right? If you had a yield farm from 3,000 to like 4,100, right? It's less than 3 months before you got knocked out of range. It was like 2 months, right? And a lot of times I was assuming like perfect entry back here, right? And if you have less than an ideal entry, you probably only capture like 50 to 80% of that. So to me, it doesn't make sense to have tighter ranges unless you're pretty much have a more hedge strategy with either perps or leverage. But for beginners, if you're just straight out yield farming with spot tokens, then it doesn't make sense to have like a really tight range. So personally, what I want to do is I could look at the weekly range, throw on some moving averages if you want. You can see here the 200-week moving average was like the support most of the time until recently that broke down, right? But you can see like there's some strong support here at 1500, and if we look at like the worst case scenario, maybe around $1,000. So depending on the risks you want to take, right, and the time horizon, I want to kind of map out like if I'm bullish on ETH, I might just do the recent low here, 1741, right? And then my top range could be around 4,200. If I don't want to leave some room for the upside, right? If I want to leave room for the upside, I might go to around $6,000 if I want to stay in range for the next 6 to 12 months. That is, if I have a bullish bias, if I believe ETH is going to recover and it's going to head higher to roughly 6,000 or even higher than that. In that scenario, I would be in range for quite a while. And if I hold a lot of USDC, I don't mind taking profits earlier. I might do something like 4,200 to even like lower bound to be around 1,000 if I'm worried about downside, right? So you can see here, if you have a super wide range, you would be in range for years, right? Like you would have been in range from here to all the way until now, like almost 1,200 days. So again, I really like looking at the weekly chart. It prevents you from thinking short term. And really, yield farming is more of a longer term strategy. It doesn't make sense to like yield farm for like 2 weeks and then switch your strategy. And you have to do a bunch of tracking, management. And if the market moves against you, then you might incur a lot of loss. And a lot of people got wrecked setting like really tight ranges, either beginning of the year or like last year, right? And when ETH price drops sharply, they were wrecked. All right, so just as an example, let's say I'm setting my range around 1,500 to be more conservative. The top range could be around 4,500. So if this was my range, right, what's the next step? So the next step, I want to hop to revert to the top position tab. I want to filter for ETH and USDC in this case. I put position H to be around 60 days so that it filters out all the noise. And you can see what I was saying, right? A lot of people got knocked out of range. They're still out of range, right? So it's not just my own opinion. So here you can see this guy is still in range on Base and Uniswap with this fee tier. Here Arbitrum and Uniswap. So what I want to do is I want to click onto that position, and you can see they're making about 40 something percent APR. This is their range. They're still in range and beating impermanent loss comfortably. And if we had wider range than them in this particular pool, then I probably expect lower APR, maybe around 30%, right? And the next pool we want to look at is the Arbitrum. But basically, Revert allows you to kind of stalk other people's pool and discover which chain, which DEX, which pool to actually enter into to yield farm with. So here you can see limit price a bit higher maximum range than the last one, still doing about 40% APR, and it's been in range for almost 200 days. So not bad at all, beating impermanent loss very comfortably. And let's use the Arbitrum and Uniswap for this example at this fee tier. So here I'm going to use Metrics Finance, the free version. I have the pro, but I'm using the free just so that you guys can try it out, see how you like it. So here I'm selecting Uniswap, Arbitrum, USDC, and ETH. I'm going to pick the 0.05% pool like they had. Make sure the USDC is the quote asset. So the current price is around $2,000. I'm going to set the min price to be around $1,500. Max price to be around $4,500 like we talked about. So you can see here at the peak of the liquidity, it's only around 20% APR based on the last 30 days volume. And you can see the volume has been dropping quite a bit. The average is around 146 million. If you reduce this to 14, it's only 10% APR. But if you expand it to 90 days, you can see the average is roughly 200 million and the APR is 28%. So let's go back to 30 days just so you get like a middle of the ground APR type. Let's say the calculation price moves around to like 1800, you're getting like 74% APR, right? If it pumps to 2300, you're getting around 47% APR. So the peak of the liquidity is basically the worst case scenario. And a lot of times if the market is volatile, you're going to be getting higher than 20% APR. And if I have $10,000 in this pool, the worst case scenario is roughly around $2,000 in fees. So the next step, we want to hop over to the Desmos to calculate impermanent loss. The value of deposit is $10,000. We're going to go over to prices. Price upper, what I had, right, 4,500. Price lower, 1,500. So price now is roughly 2,000. Price deposit, assuming you deposit right there, right, 2,000. And you can see the main purpose of this calculator is to look at the impermanent loss. So in this case, I have like 71% worth of ETH, 28%, 29% worth of USDC. If we look at metrics finance, that's roughly what we had, like 71% versus 29% USDC. So at this current price, there's zero impermanent loss. But let's say the price moves to like $3,000, right? ETH pumps to $3,000. Then we're looking at 8% impermanent loss versus holding. I would have much more USDC at around 61% in this scenario. And let's say it goes to $4,000, then my impermanent loss is around 21.5%. So you can see the impermanent loss is greater than the APR we had, right? We had 20% APR back in metrics finance, and here on the impermanent loss calculator is 21%. So in theory, if price is trading exactly at $4,000 1 year from now, you would pretty much be roughly at a slight loss, right? Because you would have just been better off to just hold the ETH and the USDC by like 1%. So in this case, it might not be worth it to take the extra risk with yield farming, but let me actually show you what would be closer to reality. So we're gonna hop back to Revert for some backtesting. The network is Arbitrum and Uniswap, ETH and USDC. And here I want to select the same fee tier at 0.05%. The min price is 1,500, like we talked about. Max price 4,500. Use 10,000 for this example. And here we can run the backtester. So based on the last 30 days of data, I would have been in range 100% of the time. I would make around $326 in fees. So if we go to our calculator here, 326 times 12 to analyze it, is roughly $3,912, right? Divided by our initial capital is 10,000. So you're getting roughly 39% yield on your investment. If you look at metrics finance, it's roughly only 20%. But as I was explaining, the price is going to move a bit. So you're getting, higher APR, right? Let's say it average around this level of liquidity, you're averaging around 34% APR. So in this particular scenario, you're looking at 39% APR in annual fees. And if the price pumps to like $4,000 1 year from now, again, 39 is greater than 21.5, 22, right? So I'm making roughly like 17% extra on top of the impermanent loss. So in this case, it then makes sense to yield farm with this particular range. And you could play with different ranges and different APRs, right? For example, my lower range, if I want to be more aggressive, or if I hold a lot of ETH and I don't really want to swap my ETH, I could set my price lower to be roughly, let's say 1950. Price upper, if I'm very bullish, 6,000. You can see impermanent loss drops to 20%. Or if I do like 10,000, right, 100,000 on the upper range, then impermanent loss is only 10%. And then you would run through the whole simulation process again. For example, on metrics, let's say the minimum price is 1950 and the max price is, let's say, like 10,000. My APR is 28%. If the liquidity concentration is roughly this height on average, right? If I go to 100,000, my APR drops to 18%, but my impermanent loss is only 10%. So I'm still netting like 8% worth of profit if ETH pumps to like $4,000 by next year. And I think it's important to note that like impermanent loss is not negative. depending on your goals, right? If your goal is to slowly sell your ETH into the pump anyway, then it makes sense to set up a liquidity pool like this. Like even here, you can see at $4,000, I would still have like 72% of my initial ETH exposure, and it's only 27% worth of USDC. And when the market looks very overheated, I could even withdraw the liquidity and sell more of my ETH. So the whole process, again, discover the pools on Revert, hit simulate in the metrics finance, and then we're going to look at the impermanent loss calculator, and then we're going to back test again with Revert finance to make sure our APR is good enough. So I know it's a bit complex for beginners, but once you run through a few examples, you will get it. Trust me, just follow through this video and try something similar. And lastly, before I hop off here, I want to explain a little bit of different strategies you could actually execute. So the three main things that really affects your strategy is like the asset you already hold, the current entry price, and your market expectation. In this current market, if you expect Ethereum to recover and you hold a lot of ETH, for example, then I might set a bullish bias liquidity pool. I either make little to no swap. Let's say my minimum range is 1950. I barely have to make any swap, or even above the current price is fine at like 2045. And then my upper range, I could set roughly around $6,000. And you can see if you expect ETH to recover, then this position would probably be in range for quite a while. So if you're holding a lot of ETH, you don't want to sell at this position, then it makes sense to go for a bullish bias. But if you hold a lot of ETH, but you're kind of bearish on ETH for whatever reason, you think there's like lower room to run through, I might drag my lower range to around $1,500. Or if your cost basis is really low, then you could still establish a more neutral or even sell most of your ETH here, depending on your goal and your market outlook. In general, I don't really like to sell my ETH or any alts when like prices are this low. And if you're holding USDC, there's more flexibility here. You could go for a bullish bias liquidity pool like this, or like neutral, right? If you don't mind taking profits earlier, something like this, 3,300 to maybe like 1,300. Or you could set up a bearish liquidity pool here, let's say around like 2,500 if you expect like the 200-week moving average to be some sort of resistance, right? And the lower range could be all the way at 0 or at like, the bottom of the range here if you expect to ETH to drop even further. And if ETH is trading at the top of the range back here in January, you're holding a lot of ETH, then you have more flexibility. Just like you have more flexibility when prices are low and you're holding USDC, right? If I want to be neutral, then this is a particular range I could do. If I'm still bullish on ETH, but I want to sell some, I might keep the lower range to be roughly the same and just expand my upper range, right? In this case, I would be swapping less ETH than if I had a tight upper range. And when I do that, if ETH doesn't go according to my plan, I still ended up with more ETH versus just holding ETH in the market. So I could do a bullish bias, the neutral, or if I expect the price to retrace hard, I could sell most of my ETH and enter into like a bearish liquidity pool here, right? 5,000 to roughly 1,500. And if I'm holding a lot of USDC at the top of the range back in December, I want exposure to ETH and USDC. I personally wouldn't enter into like a bullish bias pool like this because you're buying a lot of ETH at the top of the range. And if it retraces against you, then you're incurring a lot of impermanent loss and you would have been just better holding USDC or lending out your USDC. So in this scenario, it makes more sense to be either like neutral. Even if I had a wide range here and the position dropped out of range, it's still better than a bullish bias. In my opinion, when prices are a bit overheated, you still want to buy some of that asset. It makes sense to have a more bearish outlook. Like for example, I'm buying only a little bit of ETH here to yield farm with, and then I'm happy to dollar cost average down. So the same exact thing works with the crypto to crypto liquidity pool. if you look at my SOL and ETH position here, currently averaging about 21% APR. You can see my limit price is at 0.025 and max to be at 0.099 SOL ETH. So quite a wide range, not like a lot of these tight range farmers here. I've been in range for 28 days and the profit is quite nice if I exit this position. When I entered the pool, I was holding ETH, right? So if we drop down to the daily chart here, I entered the position around the 27th of February, around 0.06. So pretty good entry. The price is trading above my entry and I use ETH to enter the position. So if SOL is trading above that, I'm happy because I'm gaining more ETH. And even if it drops, I'm gaining more SOL exposure, which is fine. But if you look at the daily chart, you might think, it's at a cheap price, which it was in hindsight, right? But if you zoom out, SOL is trading at quite a high premium to ETH. So in my opinion, it makes more sense to have a more bearish liquidity pool, especially if I'm coming in with ETH, right? So I set a tighter upper range and a wider lower range in this scenario. And if you already hold a lot of SOL, it could make sense to enter into something like this if you're expecting SOL outperformance to slow down a bit, right? Again, it comes back to the current price, what you already hold, and what you expect to happen in the market. So that's pretty much it for the video, guys. I hope this video was helpful. I know some concepts are a bit more complex, but the more you run simulations, the more you yield farm, the better you're gonna get. And be sure to look at my other videos. It's really gonna help you become a much better yield farmer and investor. And one final quote I want to end off with is, what can go wrong will go wrong. So that's the Murphy's Law. Basically, if you run through that mindset, you're basically always preparing for the worst case scenario. Like if you're yield farming ETH and USDC, you don't want to just look at the upside and never look at the downside, right? I always try to ask myself, like, what's the worst case scenario? What should I do in this situation? Because a lot of people's portfolio are all different. There's no one size fit all solution, right? The cost basis is different. The risk profile is different. But if you always think through the worst case scenario mindset, then you're always prepared for the worst thing that happens. So thanks for watching, guys. Be sure to check out the other videos. I'll catch you guys on the next one.